Hey Anton, do you have a minute to explain a question?
Before I'm rushing to my group, actually, we're working on a group project.
May, I remember you to help me out.
Okay, what is your question?
So, how value relevance has changed from 70s to today?
Do you know the definition of value relevance?
Nope.
Okay, according to the studies, the value relevance is the ability of information that is stated in a financial report to capture and summarize the firm's value. In order to calculate the value relevance, you just need to make a statistical relation between the information that is presented in the financial statements and the market value or returns. This is my room actually. Do you want to make yourself in? Here is May, Yusan, and Do. You can stay with us if you want.
How the value relevance has changed from 70s to today?
There is a general belief that in the USA during that time the value relevance has significantly decreased. Collins, Maydew, and Weiss have conducted a research in 1997 which determined the book values and earnings lost some of its reliability. The reasons outlined were quite common. Intangibles like software or services provided became an important part of the US economy and were hard to estimate. Non-recurring items appeared more often at that time, increasing the overall confusion for the stakeholders. Also, there was a problem with the rate of negative earnings. The last issue behind was that a growing number of small enterprises decreased their reliability because they don't report the same amount of information as the largest corporations. According to Francis and Schipper, the value relevance of the different parts has changed. Earnings level and the change of return decreased. However, their research assumed that there is no systematic difference in the consumer's behavior, and no other assumptions have been made. Therefore, we may say that the value relevance in the US during that time is a very controversial topic.
So, why are you only talking about USA?
I talk about the USA because it was the biggest economy back in the time, and it's still the biggest economy.
So, I agree to what Anton said just now. During 70s to 90s, the value relevance is reduced in USA due to the earning levels. However, the changes is actually vary from country to country. For example, according to Gert, Nivsla, and Centum, in Norway, we found that value relevance of earnings and book value has increased. As a deferred tax was introduced, the presentation of the financial information became more clearer and reliable. So the same situation happened in Japan. Habit states that the value relevance of the book values and earning levels increased during those 2 decades. Although the changes in individual shareholding caused the VR to decrease to a certain extent, however, the overall trend of VR is still increasing. So to conclude, the changes between 1970s to 1990s, the value relevance of financial report is lower for countries where the financial system are more bank-oriented, such as USA. The market-oriented systems, such as Norway and Japan, tend to have a higher VR.
How the value relevance has changed from 70s to today?
From 1990s to date, Hill stated that there has been a decrease in value relevance in US. This is due to a number of reasons. Firstly, corporate scandals such as Enron. Management might misstate earning and balance sheet number to attain short-term objective. For example, Enron overstated its revenue by reporting gross instead of net sales figures. They also cover up a huge amount of debts under special purpose entity that were exempt from consolidation. Secondly, financial crises that happen have resulted in negative impact on companies' financial statement. So, many have questioned the value of fundamental financial information for investment decision-making purposes. Moving on to the other countries. There has been an increase in value relevance in other countries. The reason is more than 100 countries, such as UK, have either adopted IFRS or are in the process of doing so. Supporters of this change claim that this would be able to improve the accounting standards, which would enhance the transparency and comparability of financial reports. Therefore, by applying more transparent disclosures and reporting rules consistently throughout countries, it will be easier to gauge the performance of companies and also predict future earnings. But do you know the general change of value relevance throughout the world?
So for the general change in value relevance throughout the world, Lucy Hale said in her 2013 paper that there is a general decrease in value relevance because earnings management introduces bias into the accounting system. The reasoning behind this is the agency theory, where managers over or understate profits in the financial statements for their self-benefit. An example would be Enron, which Byung-Sun has mentioned. However, the same study also states that for valuation purposes, value relevance of income statement decreases and value relevance of balance sheet increases. The reason behind this is the asymmetric treatment of price changes due to fair value accounting. So basically, to sum up what we have discussed, in the 1970 to 1990 period, value relevance decreased in the US and has increased in the other countries. And from 1990 to present, value relevance has also been decreasing in the US, but the change in value relevance in the other countries is controversial and still debatable.
Thank you, guys.